Okay, so many traders want to trade like other traders, right? So you go on Instagram, for example, and then you see someone who takes a $200 account and he trades it and he flips it to 500. Please mute yourself when you come in. Thank you. Mute yourself. Thank you. All right. So he takes a $200 account and he flips it to 1,000. That's what we call flip, right? Okay, or the person takes a $1,000 account and he trades it, he does one trade and he takes the account to 5,000. Okay, so when you see that kind of trading, when you see someone do that kind of trading, you're like, I want to achieve this. I want to make this kind of money, right? But what you do not understand, what many traders don't understand is that it is not just about the money that you are seeing, because there are many ways to get to the money. There are many ways to get to the money. So it's not really about trying to trade the way that person trades. That's why many times on this platform, guys, I usually tell you guys that tell you guys not to trade directly when the news comes out. So you want to enter the market exactly when the news comes out. I usually prefer that you do not trade when the news comes out. Now, as I tell you that, I'm well aware that there are traders that do that. They trade when the news comes out. At the time that the news comes out, they enter the market just before the news comes out, like a minute before the news comes out. Now, there's a certain mindset you have to have if you want to trade like that. But when you see someone show you an account and says, oh, this account, I funded it $200 just now, I've turned it to $800 on this news event that came out, what you are thinking, oh, I need to do the same. What he did not tell you, what you did not know is that the last time he funded $200, he blew it and he funded another one. There's a certain mindset that he's on, there's a certain mindset that he has that enables him to do what he's doing. So first and foremost, you want to identify what kind of a trader am I? What kind of a trader am I before you determine what method is going to be best for you? Like I said, there are several ways to get to that money, not necessarily the way that person is doing it. Now, if you discover that what that person is doing is exactly what you are wired to do, and you are the same kind of trader as that person, then that's amazing. But if you realize that you are not that kind of trader, you're not the same kind of trader as that person, you want to find what works for you best, and then you want to be able to use that for your trading. There are people that I know. I have someone I know. This guy does not trade if he's not targeting 400 pips. He's a swing trader. For me personally, I don't trade 400 pips. What am I doing with 400 pips? I want to get in on a trade and get out. That's my own style of trading. That guy wants to go for 400 pips. If it's not 400, if it's not 200, he's not interested. It's like it's a waste of his time. And this same guy, I'm telling you, there was a time he mentored someone else who was making a lot of money with 10 pips. This other guy was trading 10 pips, 10 pips, 10 pips. He would make $1,000 a day trading 10 pips. And he that taught him how to trade, who mentored him, he wasn't even making as much as this young guy was making. This young guy was basically killing the market. And he who is the mentor, every time they interview this guy, they'll say, hey, who mentored you? He mentioned this other guy. Yeah, this other guy wasn't making anything close to what his mentee was making. So he now felt like, oh, maybe what I should do is I need to go and do what this young guy is doing. Let me go and take 10 pips too. But it wasn't working for him. It wasn't just working. He felt like it takes 10 pips and like, what am I doing? What am I doing 10 pips? What am I doing with 10 pips? He went back to his swing trading, and now he's doing very well with his swing trading. You see? So that's the reason why there are several ways to get to what you want to get to. So the first thing is, where you will even struggle is when you have not identified the kind of trader you are and the kind of trading you want to do. There are people who like to withdraw money every day, right? You like to be able to place a trade and you make a withdrawal every day and you see an alert in your account and you like that. That's your kind of trader. There's another guy who will be trading, who will trade and trade for a whole month and not make a withdrawal, for 3 months and not make a withdrawal. There are different types of traders, right? So when you identify the kind of trader that you are, it helps you. Someone has asked me on this platform before about funded platforms and say, okay, should I go and trade on a so-and-so funding platform? This was the advice I gave the person. I said, hey, you need to know the kind of trader you are. If you are the kind of trader that wants to trade and collect money right now, funded platforms, you will blow accounts and you will be losing your money there. So you are better off funding your account with your $500, with your $1,000, and you are making your money and you are withdrawing your money, right? So this is why I'm talking about this, why we're talking about this topic today, because it's very, very important. Traders tend to want to follow the bandwagon, jump on the bandwagon of what other traders are doing, keeping up with the Joneses or what other traders are doing. That's not what you want to do. You want to first of all identify what kind of a trader am I. Even if I give you a trade, right? Even if I send out a trade and I'm, for example, X kind of trader, and I give you a trade. Let's say I'm a swing trader and I give you a trade, and you are an intraday trader, somebody who wants to take 20 pips, 10 pips, 15 pips and bail out the market. When you enter that trade, you will realize that while I'm holding my trade and price is going up and down, up and down, up and down, you will not be able to hold it. You're looking at, oh, your money goes to $100 profit. Then it comes to 80. Then it comes to 70. You're like, no, I want to take profit and go away from here. You see, that begins to tell you the kind of trader that you are. And then what you need to do is not to fight it and say, no, the other person is correct. Because he is a professional, I know him as a professional, so he must be doing the right thing, and I must be doing the wrong thing. No, what is being revealed to you is yourself. You're basically looking into yourself. You're identifying your tendencies, and you're beginning to see that, hey, this is the kind of trader I am. This is the kind of way I like to make money in the market. There is no right way or wrong way. What matters is your way. What is your way? Okay, this is why this is very, very, very important. There are people who do the analysis and do trading on 5 minutes. They do their trading on 5-minute charts and they make money on it. There are some that do their strategy, they do their analysis on 1-hour chart, 4 hours on go to daily chart. There's a particular popular trader on Twitter who's been insulting a lot of day traders recently. He's a very popular trader, right? He makes good money, right? He's been insulting a lot of day traders. They're like, day traders are gamblers. They don't know what they're doing. And you should be swing trading. You should place one trade and it goes for 2 weeks or 3 weeks, like he does. He makes a good amount of money swing trading. But as far as he is concerned, everybody should be swing trading like him, right? So, but that is not the fact. That's not the truth. That's not the way it should be. Everybody has the way that is good for them, that aligns with their personality. And that's what you want to identify. When you identify that, you stop chasing what every other person is doing and you are able to begin to win big on your own, right? So this is why this is so important. So these are different strategies, all right, that we're going to talk about today. Now, like I said, in a different advanced class, we will have different we will break down the like nuts and bolts of each strategy so that you can begin to use it. Now, we are just doing this an overview today to just give you an idea of the kind of trader you may want to be or the kind of trader you are, and then basically to validate the way you're currently trading, if that aligns very well with your personality, and to make you understand that, see, there's nothing wrong with your style of trading. It's just what aligns with your person that you need to do. Not what someone else is doing, not what is working for someone else, but what works for you, and especially what aligns with your core personality, right? So in the future advanced class, that's going to be an advanced class where we're going to be talking deeply in the breaking like the nuts and bolts of each strategy, then so that you can begin to use it if you do not have a strategy that you're using yet, right? Or even if you have a strategy that you are using yet, there are always things that you can add to create better confirmations for whatever strategy that you're trading, right? So now, the first is trend following strategy. So this strategy involves following the trend in the market and trading in the direction of the trend. We talked about this before, right? Where you trade in the direction of the trend. you identify an uptrend, right? You identify an uptrend and you say, okay, now that I've identified an uptrend, I'm going to be trading in the direction of this trend. Or I identify a downtrend, I'm going to be trading in the direction of this downtrend, right? Or I identify a range, to identify a range. And what I want to do is I want to trade this range, okay? There are ways to trade a range. Even though the best strategy for trading a range may be to wait for a breakout, but there are still ways to trade a range because market can be in a range for a prolonged period of time. A market can be in a range for a prolonged period of time. And in that case, what you are doing is buying at support, selling at resistance. Buy at support, sell at resistance. When you must start doing that when the market is ranging. There are seasons where a market could range for a long period of time, right? It's not trending massively for buy or sell yet. It's just ranging, right? So the first one is a trend following strategy. Trend following strategy. Hold on, guys. Let me try and change the color of this. So trend following strategy. Then the next thing is a range trading. This range trading involves identifying a range bound market and buying at the bottom of the range and selling at the top of the range. That's what I said before. So you identify a range. Now, the best way usually to trade a short-term range, if it's a short-term range, the best way to trade a short-term range is to wait for a breakout of that short-term range. Let's say it's an intraday short-term range, right? You want to wait for a breakout of that range before you trade it, either a breakout to the upside or a breakout to the downside. Now, but if it's a major trend, if it's a major range that you find on the daily charts, and you still find the market, there are some pairs like euro pairs like Euro CHF, Euro AUD, those pairs usually, Euro CHF, Euro CAD, you usually find them in a range that is significant, daily range. You see them ranging for quite a long time. CAD, CAD, and all, and some kind of pairs, some cross pairs. You find them with cross pairs most of the time. Cross pairs are usually get stuck in the range for a long time. But when there are major pairs like USD pairs, they usually don't get stuck in the range for a long time. But cross pairs will usually get stuck in the range for quite some time. So that's where you then want to begin to use a range trading strategy to trade that range. But like I said, if it's a short-term range within a day, 1 hour range and all that, you can still trade it. You can wait for a breakout and then you trade it, right? So but if it's a longer term range, like ranging on a daily chart, ranging on a weekly chart, then you want to be able to trade it using a trend strategy, a range trading strategy, right? Where you are buying at support and selling at resistance. You buy at support, you sell at resistance, like that. You can keep doing that, right? You can keep doing that, or you're using a trend line. You see trends, it's just trending downwards or upwards like that. You just buy and sell at the top and bottoms of the channel. You find the price is within the channel, right? So you just buy and sell at the top and bottoms of the channel, right? So that's range trading. Another one is breakout trading. We did a class the other day on breakout trading. This strategy involves identifying a key level of support or resistance and entering a trade when the price breaks through that level, right? So we had a class on this the other day when we talked about breakouts, right? So now what you do on this one is you come into the market, you identify a trend first, then you are waiting then you get a range. Usually price moves in a particular direction, let's say buy direction, it trends upwards, then it trends downwards, right? So, but when price begins to trend upwards, when price trends upwards, then it will get into a consolidation, which is also known as a range, then before it changes direction, because price moves from uptrend to downtrend. Well, so what it does is it moves in an uptrend, then it consolidates, then before it goes into a downtrend. It goes up, goes in an uptrend, consolidates, then goes in a downtrend. So in that consolidation, usually you're waiting for a breakout, because when it breaks out, it could continue in the, let's say it's trending upwards and it gets into a consolidation. You want to wait for a breakout, because when a breakout happens, it could break out to the upside or it could break out to the downside. So what you are waiting for that time is that you have identified strong levels of support and resistance, right? Strong levels of support and resistance, and you just wait for price to go through it, break through it. We said before that when you mark a support or a resistance, what you are waiting for is for price to do what it will do at that level. Let's say a resistance. We're talking about a resistance now. When price moves to a resistance, there are two scenarios that are possible. Two outcomes are possible at that time. Number one, price will reverse from the resistance, right? Price reverses from resistance. In that case, in that situation, it will give you usually a reversal pattern, which is a price action pattern, which is a candlestick pattern. Okay, so when it gives you that candlestick pattern, you know that, okay, price is probably giving me a sign here that price wants to reverse from this resistance. That is one scenario. Then another one is when price gets to a resistance, it doesn't give you a reversal pattern, like a candlestick price action pattern. No, it doesn't give you that, because it's going to break out. So when it breaks out of it, price continues to go up. Now we're talking about a resistance. But when price breaks out of a resistance, it continues upwards. When price breaks out of a support, it continues downwards. When price breaks out of a resistance, it continues upwards. When price breaks out of as a support, it continues downwards. So what you now do is that when price breaks out of that resistance, you want to look for opportunities to buy, because a resistance has been broken. When the resistance is broken, price is going to buy and buy and buy massively. When the support is broken, price is going to sell and sell and sell massively. So what you want to do is that when price breaks out of a resistance, you are looking to buy. That's breakout strategy. That's breakout trading. When price breaks out of a support, that is more sell. And that's that you are looking to sell more at that time, and that's basically breakout strategy. Okay, it's either for a buy or for a sell. Now we have swing trading. Swing trading. This strategy involves holding positions for a few days to a few weeks, aiming to profit from short-term price movements, right? So now this is what I was talking about before, where you have a trade running for 200, you are targeting 200 pips, 300, 400, 600 pips on one trade, not on two trades, right? Why does that happen? You are that kind of a trader. You are the kind of a trader who will, remember, price doesn't move in a straight line. If price is moving to the upside now, and you are targeting a 600 pip buy move, what you have to understand is price is not going to go up there straight. It will move up and down, up and down, up and down, but it will continue to go in that direction. You have to be a trader. See, you have to be someone with a temperament to watch your trade, your profit go to 100 pips positive, and then come back to 50 pips next, come back to 50 pips. Sometimes you might enter a trade, you will go into positive and come back to break even. And the price will continue like that for a while before it moves in the direction that you want it to go. So if you are not that kind of person that can stomach that kind of movement, up and down, you just want price to do what it will do and you collect profit and go, then you know that you are not meant for swing trading. You know that swing trading is not for you. It doesn't matter how much somebody else is showing you that he's making from the swing trading. You know that swing trading is not for you, because you have already seen that, hey, this thing is not for me. Why is it not for you? Because you can see that you don't have the temperament to do that. There's a temperament to do that. You don't have the temperament to do it. And because you don't have the temperament to do it, don't let anybody force you into it and say, oh, this is the correct way to trade. There is no correct way to trade. There is no correct way to trade, right? So you stick with whatever you want to do, stick with whatever you want to do, and then you are able to do it. That's just it, right? So you see that you are not a swing trader if you cannot hold a position. You are not a swing trader. There's nothing wrong with that. Like I said before, there's a guy I knew of who was doing only 10 pips trading, 10 pips. 10 pips, 10 pips, right? He will tell you that on a bad day, he made $500. That's on a very bad day. On a good day, you make 1,000, 1,500 every single day. Dollars, not naira, dollars, not pounds. Yeah, sorry, not Zimbabwean dollar or any other dollar, not naira, not Ghanaian cedis, dollars, right? Dollars. I'm not belittling any currency, guys. I'm just saying that the dollar is stronger than all these other currencies I mentioned now, right? It's stronger, okay? So that's the reason why we deal in the market in dollars. Fine. So whatever strategy you're trading is going to work for you as long as it aligns with your person. It aligns with your person, you are good. Then scalping. Scalping is what we're talking about. Scalping, this strategy involves making numerous trades over a short period of time, aiming to profit from small price movements. Okay, so when you come into the market today and you see 10 pips and you collect profit, you are that kind of person. You want to enter a trade and close, enter a trade, close, enter a trade, close, and say today I made $50, so I made $20, so I made $100, whatever, depending on the capital you're trading with, right? That is scalping. You're going to enter 5 trades in a day, enter probably 10 trades in a day if you are very aggressive, right? That's scalping. You are entering, you're coming out, you're entering, you're coming out. Sometimes you are taking trades that are at 5 pips and you're out. 5 pips and you're out. And 5 pips can make you good money if you have good capital. Yeah, 5 pips can make you good money if you have capital, if you have huge capital, right? So that's the way it is. And when you trade like that, don't let anybody tell you that this is not the right way to trade or whatever. No, I just told you, someone who scalp 10 pips is scalping, 15 pips is scalping, right? Someone who makes 10 pips, as in, I am not a 10 pips person. I don't do 10 pips, right? For me, 10 pips is too small. I'm more an intraday trader, but 10 pips is too small. But I know someone who was doing 10 pips and he was making crazy money. So if you are a trader like that, and you decide that you want to do 10 pips, or even 5 pips, or even 7 pips, that's fine. As long as that is what you want, that aligns with you, you feel in your heart that that's best for you, then that is wonderful, right? That's wonderful. Then we have news trading. News trading. So guys, like I said, this is just for us to go through the strategies, broad strategies. In a more advanced class, we are going to be going in depth into different strategies, the nuts and bolts of different strategies, right? We're going to do that on a more advanced class. Okay, that's a more advanced class. So now, news trading. This strategy involves monitoring economic and political news events and trading based on their impact on the markets. Okay, good. So now, every month, there are certain news events that get released, or that get either every month or every so often, right? There are some major events that move the markets, all right? And usually what moves the market is dependent on what is happening in the macroeconomic world per time. What's happening in the macroeconomic environment per time is what determines what moves the market. For example, if you check right now as I'm talking to you, you will notice that the dollar appreciated very massively this evening. Just some 3 hours ago, the dollar made a huge buy. You see that USD-CAD bought very big. You notice that USD-JPY bought very big. You notice that gold crashed. You notice that Euro-USD crashed. You notice that GBP-USD crashed. You can check these things. They happened just a few hours ago. Now, why did that happen? That happened because the chairman of the Federal Reserve was making a speech to Congress, right? This is usually something that they do twice a year, and he was briefing the Congress on the progress he's making with his rate hikes, inflation issues, employment issues. He just basically came to brief Congress on the progress that he's been making and all the things he's been doing to try to take care of inflation and basically cool the economy down and return the economy return the economy back to the path of consistent price stability. Now, when he said some things he said at that event moved the market. Now, in another situation, maybe in another 6 months or so, when he does that event again, maybe it will not move the market. even though it's likely to, but it may not move the market. Right now, the reason why anything the Federal Reserve does, anything the chairman of the Federal Reserve does moves the market is because we are in an environment of high inflation. The world is in an environment of high inflation, and because the world is in an environment of high inflation, and the Federal Reserve is trying to cool down inflation on a consistent basis, whatever he does is going to move the market, because the market is there waiting for him to just say something. Oh, okay, when he says something, because anything he says gives us a hint, gives the market a hint of what they are likely to do at the next rate event, at the next FOMC meeting. Okay, so at that next FOMC meeting, are they going to be increasing interest rates? Are they going to be reducing interest rates? All of that is what the market is waiting for him to say. Okay, so these kinds of events happen once in a while. Now, then this weekend, on Friday, we have non-farm payroll. Non-farm payroll, we have non-farm payroll on that day. We have unemployment rates. There's going to be unemployment rate is going to be released. The current unemployment rate for last month is going to be released. We have non-farm payroll, that is the number of new jobs that was created last month, minus the farm industry, right? That's the non-farm payroll, right? Then there's going to be average hourly earnings. What the average hourly earnings, how much do people earn on an hourly basis? They take that as an average, and they want to know, did that increase or did that decrease? All these three numbers I just mentioned now are they have to do with employment. And employment right now is an issue in the US because it ties into the inflation narrative of the Federal Reserve. So the market now is going to be waiting for Friday for something to happen. What is going to happen on Friday? So when you are a news trader, these events are what you are looking to trade. You are looking to take advantage of them, right? Now, news traders that are called news traders that trade only the news and have traded the news for a long time, some of them don't trade anything else. They only trade news. And remember, you need a certain kind of personality to be a news trader. One such personality you must have is that you must be somebody of very high risk. You must be somebody who can put $1,000 in the market and you don't care that you will blow it on this one event. Is not a problem. Someone was telling me about how he wanted to trade. He's a news trader, right? He was preparing for his wedding and he needed money. They were using money for a lot of things. He borrowed $1,000 from his girlfriend that they were planning to get married, right? Of course, they are married now. In case you're wondering. So now he took $1,000 from her, and guess what? He blew that $1,000 in 5 minutes. Why did he blow $1,000 in 5 minutes? He blew it because he knew that if he had gotten that news event right, he would make probably $5,000 on that move, or $3,000 or $4,000. He knew that was what he was going for, but the news did not go his way, and then he blew that money. Now, if you are not that kind of person that can fund $200, $500 and blow it now, you don't have that personality. You cannot recover from it. You will be in pains. You may even say, no, Forex doesn't work. I'm not doing it again. If you are not that kind of, if you are that kind of person, we say, oh, Forex doesn't work. You know that you are not a news trader. These are some of the things, guys, that we don't tell you when we tell you that, okay, do trade like this, don't trade like this. When the news is coming out, make sure you stay away from the market. If you've been been on this channel for a while, you will know that I always say that. I'll tell you, stay away from the market, wait for the news event to happen, right? Wait for the news event to happen, give it like 30 minutes, because news events usually come out 30 minutes into the hour, like 1:30 p.m., 2:30 p.m., 8:30 p.m., like that. It's always 30 minutes into the hour when these news events are coming out. Usually, most of the news events are from the US and from elsewhere, usually come out 30 minutes to the hour. So my advice is always wait 30 minutes, wait for the news to be released, then wait 30 minutes after the news is released, then before you now see a clear direction of price movement. When you now see a clear movement of price, that's when you now begin to position yourself to trade in the direction the market has already shown you. That is a safer way to trade the news, right? But there are some people who will jump into the market immediately the news comes out. They will jump in, or they will use what they call straddling, where they use pending orders. They will use buy limit, buy stop and sell stop. And they say, okay, when price goes in one direction, I will cancel the other order. Then if it goes in buy direction, that means my buy order will be triggered. I will make money on the buy, right? And then I will not cancel the sell order. The reason why that one is risky is because if you are not the kind of person with the personality to see your money go up in smoke in 3 minutes or in 2 minutes, you don't want to trade like that. Because in as much as you are setting buy limit, buy stop, sell stop, price can go in such a way that it will take out your buy stop, it will not go anywhere. It will come back again. It will take out your sell stop, it will not go anywhere. You will lose on both sides, right? So this is, if you're not, you have to, this is why I started with, and I said, your personality is the first thing. What is my personality? What can I take? What can I not take? Right? Yes. So once you identify what you can take and what you cannot take, if you enter news trading and you are the kind of person who say, oh no, I blew my money, Forex is a scam, then you know you are not a news trader. Don't trade the news, just stay away and do your technical analysis and be happy. Right? Do your technical analysis and be happy. But then when you see somebody who turned $1,000 to $5,000 in 5 minutes, don't feel like you missed out or you lost just because you didn't do what that person did. Or you say, oh no, this person turned $1,000 to $5,000 in 5 minutes. I need to go and do that. The question is, did you know what happened when that person blew 1,000? I just told you guys now how somebody who's preparing to get married borrowed $1,000 from his girlfriend and blew it in 2 minutes in the market. Why? And as I speak to you, the guy is still a news trader. He's still a news trader. So he recovered from that and he's still a news trader. So if you are not like that, don't go into news trading at all. You can trade the news through another method, which is basically wait for the market to settle after the news has happened. Then you now take your position and then you trade according to technical analysis. And then you still make money from it. You see? And then also news traders are very high risk. Somebody can fund $1,000 and trade it with 10 standard lots. Yes. Because his goal is, if I get this trade right, I'm going to triple my money. I'm going to turn 1,000 to 5,000. That's his goal. But he also knows that if he gets this trade wrong, that 1,000 is going to go up in smoke. Yeah, it's going to blow. That account is going to, he knows, and he's ready for it. So you have to know, first of all, that you are that kind of trader and you are ready for that kind of outcome before you trade it. So you see, it boils back to your mindset. What kind of a trader are you? That's where you want to begin from all the time, right? So that's news trading. Then carry trading. Carry trading is a strategy. This strategy involves buying currencies with high interest rates and selling currencies with low interest rates, aiming to profit from interest rate differential. Now, this is not a very popular strategy with retail traders, right? So now it's usually when you talk about carry trades, most of the time you are referring to trades with JPY pairs, JPY trading, because the Japanese economy, the Japanese yen has been the economy of the country that has kept its interest rate as zero. And in fact, it went to negative interest rates from 2016 till recently, even till now. The interest rates on in the Japanese economy is basically zero to negative. It's 0 to negative, right? So that's why they tell you that the Japanese economy is the largest exporter of capital. Japanese investors usually take their monies to other places to invest. So what they do is they borrow from Japan. They borrow from Japan at low interest rates, and they go invest it in other countries, buy bonds and treasury bills from other countries that have high interest rates. So it's more like you take money that has no interest and you go and invest it in a place where you can make interest on it. That's what carry trading is. And most of the time, it's institutional traders that do it. So it's not very popular with retail traders because it requires movement of monies and all of that. So two economies that this works for most of the time, you discover that you are talking about trades like NZD JPY. NZD-JPY. So you can, people borrow money from these investors, they borrow money from the Japanese economy, they invest it in New Zealand economy because of the rate differential. One has huge interest rate, the other one has low interest rates. So when you have that kind of combination, that's what you call carry trading. So it's not a very popular thing with retail traders, right? So we'll move on to the next one, price action trading. Good. So price action trading, this trading involves analyzing the price movement of currency pairs and trading based on patterns and signals on the chart. So now we've talked about, we've had trainings on price action, right? So if you've been on those classes, or you know about price action, you know that price action is basically candlestick formation. What kind of candlestick formation are you seeing? What does it tell you, right? Let's say your price is moving and price gets to a support. When price gets to a support, what are you expecting from a support? Usually you're expecting price to bounce from a support, right? You're expecting price to bounce from a support. You know, like a ball, you hit a ball on the ground and it bounces. So that's why support is also known as a floor. A support is also known as a floor. So it's the concept of you bouncing a football, like a tennis ball, you bounce it on the ground, it bounces, right? So it's a support is also known as a floor. So when price gets to a floor or a support, what happens is that price, you're expecting price to bounce from a floor, from a support, right? Now, what will usually give you the confidence? But remember, when price gets to a floor, a support, there are two possible scenarios, right? The first one is price is likely to bounce. Price could bounce, that's one, or price could break. So when price bounces, then you are expecting to be buying, right? When price bounces off a support, you are expected to be buying. So that will usually give you a buy signal. But when price doesn't give you a buy signal at a support and it breaks, you're expecting a continuation of a sell. You're expecting the price to continue to sell, right? So now let's look at this. When price gets to a floor, which is a support, what's going to give you the confidence that price is going to bounce from there, in which case you should be buying, is a pattern, is a candlestick pattern. That's what we call price action. Maybe you will see something like a hammer candle. You see why we talked about the candle patterns we talked about the other day, right? So you will see something like a hammer candle, or you see something like an engulfing, a bullish engulfing candle, right? These are some of the very popular ones that you can see, you know, or you see something like a bullish railroad, like we call a tweezer, the one we call the tweezer, or a railroad. You can see that when you see those patterns, it tells you that price that's like giving you a signal that, hey, yes, I'm actually going to buy at this floor. Because you know, why are you looking for that price action signal before you buy? Because you know that it's also possible that price will break that support and continue going down. So since you don't want to get trapped in that wrong trade, you want to wait for a bullish pattern, a price action pattern that tells you, okay, oh, price is really going to bounce off this floor, off this support. So you see something like a hammer candle, or you see something like a bullish engulfing, or you see something like a tweezer, a bullish tweezer, also known as a bullish railroad, right? You see those kinds of patterns, that gives you confidence that, okay, price is about to buy, let me start buying. You see, so that's what price action trading is about. It's basically candlestick formation. Your ability to read candlesticks, your ability to read price pressures on a candlestick. All right. When you see a candle, like we discussed the other day when we're talking about price action, when you see a candlestick, the way that candlestick forms gives you an idea of what transpired within the time frame in which that candle was formed, right? So for example, if you see a hammer candle, it tells you that buyers were basically taking over the market at that time. So when buyers take over the market at that time and then that candle closes, there's a likelihood, a high chance that price is going to continue to buy at that time. You see, so that's price action. You are looking at the candle and you are basically assessing the formation of that candle to make a decision as to whether you should be buying or selling based off of the way the candle is formed, either through how large the candle wick is, which is the candle shadow, right? The wick, how large it is, either on top or beneath, You know, how large the body is of the candle, how small the body is. Basically, just the formation of that candle, how it is formed. You basically begin to understand what you should be doing based on the formation of that candle. That's what we call price action trading, right? And then when you go through that price action book, I dropped the price action book the other day. For those who don't have it already, or who don't know some of these things already, or who want basically to deepen their understanding of how to trade price action, right? You'll be able to get a lot of value from that book that I dropped in the group the other day. But in subsequent advanced classes, we'll still delve into price action again, right? Then there's algorithmic trading. Algorithmic trading, this strategy involves using computer algorithms to identify trading opportunities and trades and execute trades automatically. This is what they call robot trading, basically, robot trading, right? So you use a robot that is programmed. Usually what they do is they program a robot to execute trades, either a buy or a sell trade, right? So, and the thing with robots is that a robot can take your trade very well when market goes in a particular direction. And if robots can turn against you and start eating up your money if the market changes. That's the only thing with robots. But then there are robots these days that are optimized very highly. They are optimized very highly to be able to at least do some very good trading for you if you are able to get a very good one. Usually those robots are quite expensive, right? So, or you can get someone who can program it for you very, very well, a very good programmer who can do it very well and maybe keep updating it. All of that can be very useful for you for algorithmic trading. So that's algorithmic trading. The multiple time frame analysis. This is something we're going to delve into in a future class and really dig deep into it. This has to do with you using different time frames to analyze the markets, right? You look at the chart from the 1 hour, from the daily chart. Then you come to the 1 hour, 4 hour chart. Then you come to the 1 hour chart. And what you want to do is you want to see correlation. You want to see a direction. You want to see the daily chart telling you to buy, and the 4 hour agrees with that, and the 1 hour agrees with that, then the 15-minute agrees with that, right? You want to be able to analyze your trades and be able to enter and say, okay, this is where I want to enter my trade based on the fact that I can see that this market is a buy market, or because I see that this market is a sell market. All right, so we're going to take a major class and we're going to deal with each one of these very in details. But basically, the purpose of this class is to help you understand the different types of trading and to understand that there is no one that's better than the other. It just, what matters is just your own temperament, your own style, you know, something that resonates with you properly, and then you'll be able to trade the way you want to trade, not the way someone else is trading or the way someone else traded. You know, so you don't want to say, oh, this because he made so and so amount of money, because he made that money, then I want to trade like him. That may not work for you. You want to identify your own style and then lead with your own style, follow your own style, and find your own success that people now start saying, oh, okay, probably we want to trade like you as well, right? So this is a trap I've seen a lot of traders fall into. And then this will help you to identify. So pick these areas and then look into which area am I good at. This area, even if you're not good at it yet, what area would I want to be good at? What kind of trader do I want to be? Do I want to be the short term or the longer term? The scalper or the swing trader? And just remember that anyone you decide to do is okay. It's very okay. It's just about you, okay? All right, so do we have any questions? Who has a question?